Hello everyone, my name is CMA Pampiveni. Welcome back to CMA modules. In this video lecture, we will be recording module 2 of subject known as Strategic Financial Management. This chapter is about how to take decisions. Now for taking decisions, we use many techniques. Those techniques, those methods are discussed here. While taking an investment decision, a financial manager may face three alternative situations relating to the possible state of nature. Accordingly, there can be decision making under complete certainty, decision making under complete uncertainty, and decision making under risk. So we have, when we go for investment decisions, there can be three possibilities. So decision making under complete certainty, I am 100% sure this point is going to happen. I'm 100% sure it is going to rain within 10-15 minutes. Decision making under uncertainty, I don't know whether it will rain or not, but I took my umbrella and I started walking. Decision making under risk. So there are three different situations where we can go for making decisions. Decisions making under complete certainty implies that manager is fully aware about everything. Manager is completely aware. I know everything, what is going to happen in the future. Aware of all the states of the nature, that is possible events not under the control of the firm. Available and expected payoffs from the strategies under consideration for each state of nature. Since all the outcomes are fully known here, manager can construct a payoff matrix. The manager knows everything, so what manager can do, he can construct payoff metrics and best possible strategy with maximum payoff. For example, suppose manager of Medicare Pharma expects any of three states of nature, namely N1, N2 and N3, and he has three possible strategies, namely S1, S2 and S3. He has constructed a payoff matrix as follows. So you have S1, S2, S3, you have N1, N2 and N3. Okay. So accordingly what you have constructed nature, you have created a payoff matrix. If the manager knows with certainty that a particular state of nature is going to exist, he can choose an appropriate strategy accordingly. For example, if he knows that N2 is the state of nature expected, he will select S2 with the highest payoff. Unfortunately, in a dynamic business world, such a situation hardly prevails, and what anyone can actually face is either a situation of complete uncertainty or risk. Correct. Certainty, I know it will rain in next 10 minutes, that is little difficult. Certainty, decision taking in certainty, hardly such type of situation prevails. Usually we have decisions wherein we take under uncertain situations, or we take decisions under complete risk. Under conditions of complete uncertainty, the manager does not have any information regarding the expected occurrence of any state of nature. In technical terms, he does not have information regarding probability distribution of state of nature. Here, as per decision theory, a manager may use Maximax, Hurwitz criteria, Maximin criteria, Minimax criteria, or criteria of so here also we have different criteria with the help of which we can find out what is expected occurrence of from this particular, suppose if I decide yes I want to do, then what will be the outcome. So how we decide that, either with the help of return or either with the help of risk. Risk is a scenario that falls in between complete certainty and complete uncertainty. In other words, it is a situation where manager has information regarding probability distribution of the state of nature. The probabilities are calculated based on past experience, and hence for a totally new situation, this strategy is not at all applicable. Under this situation, manager calculates expected value of each individual strategy based on the probabilities assigned to the state of nature and the payoff associated with each strategy. The strategy with highest expected payoff is ultimately selected. Okay. So here how we decide. Risk is nothing but it is a scenario which falls between complete certainty and complete uncertainty. In other words, it is a situation where manager has information regarding probability distribution of state of nature. So here manager will have to find out information with the help of different probability. The probabilities are calculated based on past experience. How probabilities are calculated? It is calculated based on past experience. And hence, the totally new situation, for a totally new situation, this strategy is not at all applicable. So based on past data, what we are doing, we are calculating probability. Under this situation, manager calculates expected value of each individual strategy based on the probabilities assigned to the state of nature and the payoff associated with each strategy. Okay. So how we will have sums, we'll have outcomes, that is income or profits or any outcome in one column, and in other column we will have probability of achieving that outcome. So say if I am receiving 100 rupees as my profit, so 10% probability of achieving 100 rupees as profit. I just have to multiply. Here also they have done the same thing. They have, for finding out expected payoff, expected net present value, I just have to multiply. Expected net present value is my final outcome, final answer which I have to show it to my examiner. So that is one of the method of solving my sum. Okay, so of taking decisions whether I should accept or I should not accept. So we'll see further that expected NPV is one of the method. So for finding out answer with the help of expected NPV, it is just you take your outcome, whatever is your outcome, profit, interest, whatever, you multiply that with your probability, you are done with it. Let us assume that in our previous example, the probabilities associated, okay, so they have taken an example. Element of risk and uncertainty are integral to a long-term investment or capital budgeting decisions. Yes. Now, whether I should import this machine or buy it locally, should I go for import? Should I buy it? Uske bina chalega, I have to answer, I have to take this decision. So such type of long-term investment decisions are known as capital budgeting decisions. So element of risk and uncertainty are integral to a long-term investment or capital budgeting decisions. They are integral to long-term, they are important. Without that, we cannot work. Hence, appropriate tools must be used to evaluate investment alternatives to arrive at best strategy. While dealing with risk and uncertainties in capital investment decisions, a financial manager resorts to various alternative techniques based on principles stated above. Some of the important techniques are certainty equivalent approach, risk adjusted discount rate, expected NPV and standard deviation, decision tree analysis. So this is nothing but your techniques. With the help of these techniques, you will find out your answers. You have sums on these 4 techniques. Certainty equivalent approach, you have one sum CE karke aayega. You will get abbreviation CE. So that is certainty equivalent approach. Risk adjusted discount rate, one more technique, one more method of solving sum. Expected NPV and decision tree analysis. So of these 4, now what you have is, see, till now what you were having what is decision, how you take decision, example of it, and you have 4 types of technique to take decisions. Now, in the further part of the chapter, what they are doing, they are explaining you one technique, their sums, one technique sums, one technique sums, one technique sums. So what I'll do is, I'll take this 4th technique sums first. They are very easy compared to others. Others are also easy. This chapter is easy, very scoring. I'll focus on 4th technique, decision tree analysis, and then we'll go for the other techniques. So let me take you to page number 11, sum number 11, page number 87. So here if you see, a firm has an investment proposal requiring an outlay of rupees 80,000. See, you are investing, you have an outlay of 80,000. Investment proposal is expected to have 2 years economic life with no salvage value. Investment proposal is expected to have 2 years economic life with no salvage value. There is no salvage value. In year 1, there is 0.4 probability that cash inflow after tax will be 50,000. See, again I'll go through the question. So you have an outflow of money, that is 80,000. Investment proposal is expected to have 2 years economic life with no salvage value. There is no salvage value. In year 1, there is 0.4% probability that cash inflow after tax will be 50,000 and 0.6 probability that cash inflow after tax will be 60,000. So 50,000, 60,000 is your income. You are getting in year 1, you are getting 50,000 and chances of getting 50,000 is 60%. Chances of getting 60,000 rupees is 40% chances of getting 50,000 rupees and 60% chances of getting 60,000 rupees. So that is your year 1. Probability assigned to cash flows after tax for year 2. You have cash flows, cash inflows, income for year 2 and probabilities, inflows and probabilities. Okay. The firm uses 8% discount rate for this type of investment. So discount rate is nothing but you are investing today at year 0, 80,000. At year 1 you are getting 50,000 and at year 2 you are getting 24,000. So year 2 means in 2026 I will be getting 24,000. So what is the value of that 24,000 today? I'll find out present value. In 2025, I will be getting 50,000. So what is the value of that 50,000 today? Present value. I will be finding out. So that present value is nothing but 8% discount rate. Why we are doing it? Because with inflation, the value of money comes down. So we will apply this factor and we'll find out the present value of money. Sum is really very easy. Let us start with it. Construct a decision tree. So first thing you are supposed to construct a decision tree and calculate expected NPV. So let us go for decision tree first. So see, you have a this way you have to prepare your decision tree. You have a cash outlay of 80,000. From this 80,000, you have your income 50,000 in year 1 and 60,000 in year 60,000. So 40% chances that you can get 50,000 as income and 60% chances that you can get 60,000 as income. Now what you are supposed to do here is in year 2 you are getting 24,000, 32,000 for 44,000, their probability. So this diagram is completely prepared from the question, everything from the question. Now what I will be doing is path, that is serial number 1, 2, 3, 4, 5, 6. Now what I will be doing is I will be taking this 0.4 into 0.2, 0.08, 0.4 into 0.3, 0.12, 0.4 into 0.5, 0.20. So this is your joint probability. 0.60 into 0.40, 0.24, 0.60 into 0.50, 0.30. So you have your joint probability. Okay, this is nothing but your joint probability. Now what you are supposed to do, you take your path here 1, 2, 3, 4, 5, 6. Okay, then what else you are supposed to do? You have 50,000, 50,000, 50,000 year 1 and 60,000, 60,000, 60,000. Now this 88% they must have given you here, the discount rate. We will learn how to calculate this, but otherwise here, since in the question only they have given, I'll take discounting rate, that is PV factor, inflation rate for year 1. It comes with different names. For year 1, I'll multiply, I'll get my year 1 present value. Same way for year 2, you have 6 outcomes. You take 6 different outcomes in year 2, you multiply with PV factor. PV factor for year 2 remains same irrespective of my income. You multiply, you will get your answer. Okay, now what you are supposed to do, you take your year 1 and year 2 income, total it up, that is total cash inflows. You have your outflows, compare it with outflows. You are getting negative NPV or positive, you have to check that. If it is negative, that project is not acceptable. If it is positive, that project is acceptable. But your entire project has 6 different outcomes. Okay, it is not project wise, only one project and 6 different outcomes. Now what I'll do, I'll take this NPV here, I'll multiply with joint probability which we calculated above. I want to calculate expected NPV, no? So expected NPV formula is, you take your NPV and you take your probability, you multiply. So I was having different probabilities. I was not having one probability. So I consolidated probability by multiplying. I have joint probability. I'll multiply, I'll get expected NPV. Okay, total it up. It is getting positive. So you have to accept this project. If suppose NPV is negative, you have to reject. This figure 8,508 is known as NPV. Okay, net present value. Now accordingly you can answer the rest questions. So what net present value will the project yield if worst outcome is there? So whatever is negative you take, select that. So minus 1050 is the highest negative, that will be the worst outcome. What will be the best outcome and probability of that occurrence? Best outcome. So best outcome is path 5 when NPV is at 18,419. Okay. Path 5 is the best outcome. How I selected path 5 from here, which is the highest 5,525. So fifth path is the best outcome. Then what else you have? You have, will the project be accepted? Yes, project will be accepted. So this way you have to go for decision tree analysis. Sum number 11 be completed. Then we'll go for sum number 10. Firm has an investment proposal requiring an outlay of 40,000. In our last sum, outlay was 80,000. Here in this sum, outlay is 40,000. Investment proposal is expected to have 2 years economic life with no salvage value. In year 1, there is 0.4 probability that cash inflow after tax will be 25,000 and 0.6 probability that cash inflow after tax will be 30,000. Probabilities assigned to cash inflows after tax for year 2 are as follows. So you have 25,000 and here you have 30,000. In year 1 you have two outcomes. Either you will get 25,000 or you will get 30,000. Chances of getting 25,000 is 40% and chances of getting 30,000 is 60%. Probabilities assigned to cash inflows after tax for the year 2 are as follows. So you have 12,000, 16,000, 22,000, 20,000, 25 and 30. So you have different probabilities. Firm uses a 12% discount rate for this type of investment. Construct a decision tree for proposed investment project. Construct a decision tree. So you are supposed to construct a decision tree. You have a cash outlay of 40,000. From this 40,000, you are getting income of 25,000 or 30,000. 25,000 income, the chances of getting 25,000 income is 40% and chances of getting 30,000 income is 60%. Now chances of getting 12,000, 16,000 and 22,000 is 20%, 30% and 50%. So you have your probabilities, you have your income, you have your income at year 1, income at year 2. You just have to multiply 25 joint probability 0.4 into 0.2, 0.4 into 0.3. If you multiply, you will get joint probabilities. Once you get joint probabilities, after that what you are supposed to do, you take your income at different levels, 25,000, 30,000. You take income at different years, year 1, year 2 and multiply with PV factor. So here in this question, they have not given you PV factor, you are supposed to calculate. So it is very easy to calculate PV factor. So it is 1 divided by 1.12. So how you are getting 1 divided 1 by 1.12? 12%. So 12 upon 100. You will get 0.12. 0.12 to that you add 1. So 1 by 1.12 if you do in your calculator, you will get 0.8929. Without touching anything, again you press equal to sign, you will get 0.7972 for year 2. Okay. So this way you have to go for calculation of cash inflow for year 1, cash inflow for year 2. Detailed explanation of how to find PV factors. I have prepared one video lecture. I'll link that video lecture here in this with this video lecture so that it will be easy for you all to check how to calculate PV factor. So you have to multiply, you have to find out your present income. Once you find out your present income, add it up, sum it up, you'll get total cash inflows. Compare it with your outflows, you'll get net present value. Again, net present value, whatever you have, multiply with your joint probability, you will get expected NPV. Based on expected NPV, you are supposed to answer balanced questions, worst outcome, best outcome and whether to accept project or not. So illustration number 10 and illustration number 11 belongs to decision tree analysis. So here we have completed one method, one type of question, that is decision tree analysis. I hope you are comfortable with the sums, whatever we did in this lecture. With other techniques such as certainty equivalent, expected NPV, I'll prepare another video lecture. Thank you.